To access more advanced researches, applications, and our latest published personal intelligent multi-agent deep value intelligence, welcome to explore and join deepvalues.ai community. Track total market temperature. Welcome to search and download iOS app Buffett Indicator from Apple App Store. So imagine a company that basically just makes heavy brass metal parts for city sewers.
Right, like real old school industrial stuff.
Exactly. But now imagine that same company somehow boasts like software margins that would make a Silicon Valley startup completely jealous.
Completely defies those traditional industrial stereotypes, like you expect a company bending metal to have slow grinding growth and cyclical layoffs, not cloud subscriptions, and massive profit margins.
Seriously. So welcome to our deep dive. For you listening, our lens today is entirely focused on Badger Meter ticker symbol BMI. We've got this incredibly detailed deep value intelligence report published on April 17, 2026. And our mission is to basically figure out how this 100-year-old legacy water meter company is attempting to digitize like the entire global water cycle.
Yeah, and the central tension in this report is just jarring. I mean, on paper, BMI is this absolute compounding machine. They are generating a 28% return on invested capital.
Wow.
Right, and they have nearly a 20% return on equity. Plus, they carry absolutely zero debt.
Zero. That's wild.
Yeah, literally zero. Any traditional stock screener would flag this as a screaming buy immediately. Yet, the Deep Value AI system actually tagged the stock with a remarkably cautious neutral WASI-H rating.
Oh, interesting. So we have this business that passes like almost every single quality test, but then it entirely fails the pricing test.
Exactly.
Let's figure out how that happens. Starting with the actual mechanisms of the business, because if you're listening to this and you're picturing a guy in a utility truck driving around like checking a spinning dial on the side of a house, you are completely missing the transformation here.
Oh, absolutely. The physical hardware has undergone this massive evolution. So BMI is essentially transitioning cities away from those old mechanical meters to their new E-series ultrasonic meters.
Okay, I read about those and said those ultrasonic meters have zero moving parts. But, I mean, how do you even measure the physical flow of a liquid without a wheel or a dial, physically spinning inside the pipe?
It basically comes down to sound wave physics.
Kant waves.
Yeah. So instead of a physical wheel spinning as the water pushes it, these E-series meters actually shoot ultrasonic sound waves across the inside of the pipe. Right? And by measuring the microscopic differences in how long the sound takes to travel against the flow of the water versus with it, the internal computer can calculate the exact volume of water passing through.
That is so cool. So there's no friction at all.
Exactly. Zero friction, zero wear and tear. And because of that, it never degrades in accuracy over time.
Okay, so that totally solves the measurement problem. But how does that data get from, say, a dark concrete sewer in a random residential neighborhood back to the city's billing department?
Yeah.
The report says they pair these meters with what they call Orion cellular radio endpoints. But why use cellular? If a city wants to build a smart grid, wouldn't they just build their own centralized radio towers?
Well, a decade ago, that was actually the industry standard, and honestly, it was a total nightmare.
Really? Why?
Because building proprietary radio towers requires massive capital expenditure. I mean, you have to buy the land, pour the concrete, build the actual tower, and then, pay technicians to maintain the whole thing forever.
Oh, right. That sounds super expensive for a small city.
It is. So BMI looked at all that friction and just decided to pivot to a cellular-first approach. They basically realized, hey, AT&T and Verizon already have towers everywhere. Why are we reinventing the wheel?
Okay, I get that. But wait. Standard 5G doesn't really penetrate underground, right? Like, my cell phone barely even works in a parking garage, let alone buried under a cast iron manhole cover.
Right, which is exactly why they don't use the standard consumer cellular networks. They piggyback on specific public networks using LTE-M and NB-IoT technology. Narrowband Internet of Things. These are low-frequency, low-power networks that are specifically designed for connected devices.
Oh, I see.
Because the frequency is so low, it can easily penetrate concrete, dirt, heavy metal lids, all of it. And since it requires so little power to transmit those tiny packets of data, the battery inside the BMI meter can actually last 20 years.
20 years? That's insane. So the city gets a full smart grid without having to literally become a telecom operator.
Precisely.
Okay, so they install the ultrasonic meter, they attach this cellular endpoint, and then they feed all that continuous data into their cloud-based software platform, which they call Beacon.
Yep, the Beacon platform.
It sounds like this fantastic software transition. But let me just challenge that narrative for a second. I'm looking at the 2025 full-year data from the report, and 65% of BMI's revenue still comes from physical utility hardware.
Sure.
Only 23% is actually software and services.
Yeah.
So aren't they still just a hardware company hiding in a tech company's trench coat?
I totally see the angle there, but you have to look at how that revenue mix dictates their profitability. Like, think of the physical hardware as the root system of a tree.
Okay.
It's expensive and really labor-intensive to plant those roots in the concrete, right? But once they're in the ground, they feed the high-margin software leaves for decades.
Ah, so it's like a structural shift.
Exactly. Yes, the hardware makes up the bulk of the revenue, but the beacon software is what drives the structural margin expansion. Because of those ongoing software subscriptions, BMI's gross margins have climbed to 41.7%.
Wow.
And their operating margins hit 20% in 2025.
So the hardware basically just gets them in the door, and then the software supercharges the profit.
That's it.
But, I mean, selling a 41% margin product in the industrial space usually puts a massive target on your back. Like, if I'm a rival tech company or some massive conglomerate, why don't I just build a slightly better dashboard, undercut them on the software price, and just steal all their municipal clients?
Because you aren't fighting one big national centralized water grid. You are fighting 50,000 tiny, incredibly conservative local water districts and city council.
Ah, right. The classic municipal monopoly.
It is the ultimate fragmented market. I mean, just imagine the sheer bureaucracy of a small town city council.
How painful.
Right. Once they finally approve the budget to install thousands of BMI meters, deploy all the cellular endpoints, and fully integrate that beacon software into their highly customized billing and customer service systems, the friction to change vendors becomes immense.
Yeah, the report notes these systems are locked in for the lifespan of the hardware, which you said is what, a 15 to 20-year replacement cycle?
Exactly. 15 to 20 years. The cost and the political headache to basically rip and replace that entire ecosystem just to switch to a competitor like Xylem or Itron, it would be in the tens of millions of dollars.
So once BMI wins a contract, they essentially own that utility's data flow for an entire generation.
Yep. And they have massive macro tailwinds that are actually forcing these cities to make these upgrades in the first place. Like, water is rapidly becoming a highly precious, very expensive commodity due to global scarcity and increased droughts.
Right. Cities literally can't afford to lose water.
Exactly. They simply cannot afford what they call non-revenue water.
Non-revenue water.
Yeah, that's the industry term for clean, treated water that leaks out of broken pipes before it ever reaches a home to be built.
That makes total sense. Plus, I imagine the regulatory pressure is mounting too, right? The EPA's recent lead and copper rule improvements, the LCRI, that basically forces municipalities to invest in high-precision monitoring just to stay compliant with federal law.
Oh, absolutely. Cities have to buy this technology now whether they actually want to or not.
Wow.
And BMI management isn't just relying on organic growth from those regulations either. They are aggressively widening this moat through highly targeted M&A.
Right. They've been buying up companies.
Yeah, but they aren't making reckless mega mergers. They are buying niche technology to expand what they call their blue edge ecosystem so they can essentially monitor the entire water cycle.
The acquisition of SmartCover in early 2025 is a great example of that. That brought in like $40 million in sales. But
yeah.
What exactly are they monitoring with that?
So SmartCover specializes in stormwater and wastewater. They put these little sensors under manhole covers to detect when sewer levels are rising dangerously high.
Oh, gross, but very necessary.
Very. It allows a city to dispatch a crew to clear a blockage before raw sewage actually overflows into the city streets or, local rivers. And then in April 2026, BMI acquired UDLive over in the UK, which adds even more advanced acoustic sensors for sewer monitoring.
Okay, so they are shifting from just measuring the clean water going into a house to becoming the central nervous system for a city's entire water infrastructure.
That's a great way to put it.
Clean water, wastewater, stormwater, it all just feeds right into one BMI dashboard.
Yeah.
Though I have to say, having all that critical civic infrastructure digitized and centralized in the cloud, that sounds like a massive cybersecurity target.
It is a very real vulnerability, and honestly, it's the unmodeled tail risk of this entire digital transition. Like, a cyber attack on a city's water grid isn't just a data leak, it's a physical crisis.
Yeah, people need water.
Exactly. We should definitely explore how that impacts their long-term viability, but first, I think we need to look at the financial armor they've built to protect against, traditional market threats.
Oh, for sure. Let's get into those 2025 numbers because the financial engine here is just staggering. Revenue crossed the $900 million mark, hitting $916.7 million. Free cash flow reached nearly $170 million.
Yeah.
and their free cash flow margin hit a record 18.5%, just pure cash generation. But the metric that stands out the most to me is the debt. They have absolutely zero debt and a $226 million cash pile. Is a debt-free balance sheet really that big of a competitive advantage, or are they just being like overly conservative?
Well, in the deep value framework, we look for this concept of anti-fragility.
Anti-fragility.
Yeah. A fragile company breaks under market stress. A robust company just survives it. But an anti-fragile company actually weaponizes that stress against its competitors.
I like that.
Think about the macroeconomic environment recently. When interest rates spiked up to 7%, highly leveraged industrial competitors suddenly found their borrowing costs were just crippling their cash flows.
Right. They were paralyzed just trying to service their existing loans.
Exactly. While those rivals were literally choking on interest payments and cutting their R&D budgets, Badger Meter just reached into its checking account. They can acquire a UK startup like UD Live with straight cash.
No banks required.
Right. They don't have to worry about refinancing debt maturities or appeasing bondholders. They have total strategic freedom precisely when capital is at its absolute most expensive.
And management clearly knows how much excess cash they are generating, too. I mean, they just increased their dividend for the 33rd consecutive year.
Which is huge.
But more importantly, in early 2026, the board authorized a $150 million stock buyback program. Companies authorize buybacks all the time, though. I mean, often it's just to offset the dilution from the stock options they give their own executives.
That is usually the case, yeah. But the language in this specific authorization is really crucial. BMI's board explicitly designated this for opportunistic repurchases.
Opportunistic, meaning they're waiting for a drop.
Yes. They aren't just systematically buying a set amount every single month. They have a war chest ready to deploy whenever they believe the broader market misunderstands their stock and drives the price down artificially.
Which perfectly contextualizes this major signal from the report. The CEO, Ken Bockhorst, who's basically the architect of this entire digital SaaS transition, personally bought 3,300 shares of his own company's stock on the open market during a dip in early 2026.
Open market insider buying is arguably the strongest signal in all of value investing. I mean, executives will sell their stock for 100 different reasons.
Sure, they need to buy a house, or pay a massive tax bill, or just diversify.
Exactly. But they only take their own after-tax cash and buy stock on the open market for one reason. They genuinely believe the current price is significantly lower than the intrinsic value.
Right, and that was over $500,000 of his own money.
Yep.
So let's pause here and look at the whole picture. For you listening, you hear about a company with zero debt, a 20-year municipal monopoly, record free cash flow, and a CEO dropping $500,000 on his own stock.
Yeah.
You are probably wondering why we aren't telling you to just back up the truck and buy this immediately.
Right.
So why on earth did the intelligence system give BMI a cautious what's-he-H rating?
This is where we hit the classic deep value conflict. It all comes down to the strict separation between a great business and a great investment.
Okay, unpack that.
Well, the price you pay determines your return, regardless of how good the underlying asset actually is.
Right. Let's lay out the bull versus bear debate then. The bulls look at those 41.7% gross margins and argue that BMI has successfully executed this structural SaaS transition, so it obviously deserves a massive tech company valuation multiple.
Sure.
But what is the bear argument? Like, if the technology is so good, what is the downside?
The bears point to the harsh reality of municipal bureaucracy. Just look at Q1 of 2026. BMI's revenue actually dropped 9% year over year.
Dropped? But I thought they were growing.
They are, structurally. That drop wasn't because they lost market share to a competitor. It was totally due to the extreme lumpiness of municipal project approvals and physical installation delays.
So even if a city really wants the software, the city council still argues over the budget for, like, months.
Exactly.
And then, I don't know, a bad winter storm delays the physical crew from actually digging up the streets to install the meters.
Precisely. That lumpiness just proves that despite the beautiful Beacon software dashboard, BMI's revenue recognition is still fundamentally tethered to the slow, physical deployment of heavy infrastructure. You just can't download a water meter from the App Store.
Yeah, that makes sense. And when you run this reality through the strict Graham and Buffett valuation tests from the report, the results are super polarizing. Like, BMI passes every single business quality and safety test.
Oh yeah, flying colors.
Return on equity, pass.
Yeah.
Debt to equity, pass. Free cash flow consistency, pass.
Yeah.
But then it spectacularly fails the valuation tests.
Because the deep value framework is just ruthless on price. Generally, a value investor wants a price-to-earnings ratio under 15. BMI has been trading at a PE multiple between 26 and 33.7.
Whoa.
And their price-to-book ratio is over 6. The market is basically already pricing in years of flawless future growth and placing this enormous premium on their software intangibles.
Let's dig into the discounted cash flow models, the DCF, because the math really illustrates the lack of a buffer here. Right?
Yeah, the report ran multiple DCF scenarios to find the stock's intrinsic value. In a nominal scenario, assuming BMI can somehow maintain its historical 10.5% growth rate for another entire decade.
Which is tough to do.
Very tough. But if they do, the intrinsic value sits around $165 per share. But if you use more conservative cash flow models, anticipating those municipal slowdowns we talked about, the intrinsic value drops closer to $126.
And the current stock price mentioned in the report is hovering right in that 125 to 161 range. So it's essentially trading exactly at its intrinsic value right now.
Exactly. Which leaves absolutely zero room for error. Deep value investing strictly demands a margin of safety.
Right. You never want to pay 100 cents for a dollar because, your growth assumptions might be slightly wrong or some huge macro shock could hit. You want to buy a dollar for 70 cents.
Yes, exactly. So to get a true 30% margin of safety on BMI, the stock would physically need to drop to around $115 per share.
Which is a pretty big drop from here. The report uses a Peter Lynch framework to explain this transition, which I thought provided a great mental model.
Oh yeah, the Lynch categories.
Yeah. In Lynch's terms, BMI used to be a fast grower. During the initial rollout phases of these smart meters, they were just compounding earnings at 20% a year.
Right.
But as market penetration naturally gets higher, they are shifting into a stalwart. They are highly reliable, incredibly profitable, and totally immune to debt crises. But they're probably going to grow closer to like 10% a year going forward.
And the broader market has already recognized that BMI is no longer just bending brass. They're pricing it as an elite infrastructure digital platform. But paying a 30 PE for a 10% grower is, it's the definition of a wonderful company at a fair price rather than a fair company at a wonderful price.
Right.
It is priced for absolute perfection.
And when a stock is priced for perfection, any minor hiccup like a delayed AMI deployment in a major city or a slight miss on quarterly earnings or even just a broader macroeconomic shift that compresses high-tech multiples that could send the stock price tumbling, even if the underlying business remains perfectly healthy.
Exactly. Which actually brings us back to that cybersecurity tail risk we flagged earlier.
Oh, right. Let's talk about that.
As BMI successfully turns these 50,000 fragmented water districts into a centralized, cloud-connected nervous system, the threat vector changes completely.
Yeah, we've seen ransomware attacks paralyze hospital networks and oil pipelines. If a major municipality's beacon dashboard gets compromised, what actually happens?
It's terrifying to model, honestly. A hacker wouldn't just be stealing credit card data. They could potentially manipulate the flow data, tricking the software into ignoring massive main breaks.
Oh, wow.
Or worse, they could target the wastewater systems like SmartCover, blinding the city to rising sewer levels until raw sewage physically backs up into residential homes.
That is horrifying. And that is a vulnerability built directly into the digital moat.
Yeah.
Like, the analog meters were super inefficient, sure, but they were unhackable. Now, a single major breach could trigger a catastrophic loss of confidence from those highly conservative city councils.
Right. They might pause their tech rollouts entirely, which would just absolutely shatter that high PE multiple.
It is a risk that simply doesn't show up in a spreadsheet or a DCF model today. But as the digital water cycle becomes the standard, securing that data becomes just as vital as securing the physical water itself.
100%.
So what does this all mean for you listening? How do you categorize Badger Bidder in your own portfolio strategy? If you lean toward strict value investing, BMI goes straight onto your watch list in bold ink.
Definitely.
You understand the impenetrable 20-year moat, you respect the weaponized balance sheet, and then you just sit on your hands. You wait for a broader market panic, a temporary municipal funding delay, or some overblown earnings miss to drag the price down to that $115 margin of safety.
Conversely, if you are a growth-oriented investor, or if your mandate focuses on long-term climate resilience and ESG, you have a much tougher decision. You have to evaluate whether their Beacon software subscriptions can actually continue growing at 27% year over year.
Right.
If they can maintain that hyper-growth in the SaaS segment and successfully upsell the storm and sewer monitoring to all their clean water clients, well, that premium multiple might actually be justified in the long run.
It really is a brilliant case study of an industrial dinosaur successfully rewriting its own DNA without alienating its core customer base. Disclaimer: all analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for educational and research purposes only and does not constitute investment advice. Conduct your own due diligence before making investment decisions. If you'd like to access wider topics, including life and investing philosophy, please subscribe to our sister channel, Deep Values. Don't forget to like this video. Much appreciated.